Applying support and resistance levels to your charts are very useful technical tools to use in your trading. Support and resistance levels are seen as important in terms of market psychology and supply and demand, so they may be helpful in identifying trade opportunities. Traders may adopt two methods. One is the bounce and the other is the break. In simple terms, the support is the price level through which a stock or market seldom falls. Resistance, on the other hand, is the price level that a stock or market seldom surpasses. Support and resistance levels are levels at which a lot of traders are willing to buy in case of a support or sell in case of resistance. To identify support and resistance levels, look for a series of low points where a stock or currency pair falls to this level but then falls no further. This would be the support level. Similarly, when you find that the stock or currency pair rises to a certain high but no higher, you have found a resistance level. When the forex market moves up and then pulls back, the highest point reached before it pulled back is now resistance. Conversely, as the market continues up again, the lowest point reached before it started back is now support. The reverse is true for a downtrend. This is why when a support or resistance level is broken, it suggests that the relationship between the asset's supply and demand has changed, and new support and resistance levels will likely be established, a new ceiling and a new floor. It's also worth remembering that support levels can often turn into resistance, and vice versa. For example, once the price breaks below a support level, the broken support level can turn into resistance. And the same goes for resistance turning into support. Remember, it is all about the shift in supply and demand. For example, if a price breaks past a support level, that support level can often become a new resistance level. The opposite applies as well. If the price breaks a resistance level, it will often find support at that level in the future. Oftentimes you will see a support or resistance level that appears broken, but soon after you find that the market was actually just testing that level. Now, when looking at candlestick charts, you will see that these tests of support and resistance are usually represented by candlestick shadows. Notice how the shadows of the candles break past the support level, but end up closing above it. That suggests the market was just testing that level. The more often a support or resistance level is tested, which is touched and bounced off by the price, the more significance given to that specific level. Sometimes the price can actually break through the support level, but end up rising back above it. As you can see, this was not a real breakout. You can see the support was not actually broken. In fact, it is very much intact, and now even stronger. This is what we would refer to as a false breakout. Now, as I mentioned earlier, there are two trading strategies which can be used based on support and resistance. The first, right after the bounce, and the second is known as breakout trading. The idea behind this method is to wait for a bounce from the support or resistance level to execute a trade. Now, the idea of the bounce is that traders think that history will repeat itself, and the bounce is more to do with market sentiment than anything else. Traders believe that the stock or currency pair has bounced back off a particular support or resistance level, the greater the supporting evidence for that level. Now, many traders also choose to use trend lines and other technical indicators such as the RSI, which is the Relative Strength Index, slow stochastic and moving averages to derive logical levels of support and resistance in an asset. But one error many new traders make is that they set their orders directly on support and resistance levels and then wait for their trade to materialize. Now, while this may work at times, more experienced traders choose to place a stop just below support or just above resistance. With this approach, those traders believe that they are not locking themselves out of potential bounce, but instead protecting themselves against taking a larger loss should the support or resistance break, as the stop loss would then close their position at the chosen level. The second approach is breakout trading, and the strategy is completely different to bounce trading. Whereas with the bounce trading strategy you are waiting for a bounce to buy or sell, instead with the breakout strategy you use a break of a support or resistance as a supporting assessment to trade, assuming that the breakout is expected to be followed by a rally. A resistance breakout signals that demand, The bulls had gained the upper hand, and as support break signals that supply, the bears have won the battle. With this approach, you would just place your stop loss just below the resistance or just above support. This way, if it is a false breakout, you can hopefully get out with only a small loss. Remember, a support or resistance is only considered to be broken once the body of the candlestick has broken through the line. When breakout occurs, volume increases. The more significant the escalation, the more valid potentially the breakout would be. Now you have been introduced to support and resistance lines, start practicing to use them. Just remember, you can use support and resistance to help manage risk in your trading strategy and therefore assess market conditions and enter positions. Once you've got the hang of using them, try using them together with diagonal support and resistance lines, otherwise known as trend lines. Together, alongside other technical indicators such as the RSI, which is the Relative Strength Index, slow stochastic, and moving averages, they can be very useful tools in helping technical traders analyse the trend of the market. Now, if you're new to using trend lines, take a look at LCG TV's Trend Lines education video, which will show you ways to identify possible trends and use multiple timeframes.